Every single time someone on Earth presses play on Spotify, the company quietly writes a check, a micro check, fractions of a cent, but multiplied across 100 billion streams a year, those fractions become something monstrous. Spotify pays more to the music industry than almost any other single company on the planet. In some years, it has paid out over 70% of every dollar it makes straight back to the record labels, publishers, and artists whose songs live on its servers. That is not a business. That is a toll booth with a very expensive flag. And yet, despite bleeding cash on paper for most of its history, despite posting billion-dollar losses, despite a stock chart that has looked like a heart monitor hooked up to a very anxious patient, Spotify is now the undisputed king of audio streaming. 600 million users, tens of billions in annual revenue. A market valuation that has at times dwarfed entire legacy record labels it supposedly depends on. So how do you build a giant? On an engine that loses money on almost every unit it sells. How does a company that technically cannot afford its own product become the place where the world listens to music? This is the story of how Spotify turned the oldest trap in the media industry into a strange, slow, deliberate fortress. Because the thing you think is their weakness, the razor-thin margin on every stream, is actually the thing keeping everyone else out of the door. To understand Spotify's weird economics, you have to rewind to the world it was born into. In the early 2000s, the music industry was on fire, and not in a good way. Napster had detonated the CD business. LimeWire, Kazaa, and a dozen other file-sharing tools had trained an entire generation of listeners to believe music was free. Global music revenue, which had peaked at around $23 billion in 1999, was collapsing. By 2008, it had almost been cut in half. Record labels were panicking. Artists were furious. Lawyers were printing money suing teenagers. Into this chaos walked two Swedes, Daniel Ek and Martin Lorentzen, with a very strange pitch. Their idea was not to fight piracy with lawsuits. It was to make a legal product so convenient, so fast, and so seamless that stealing music would feel like more work than paying for it. Millions of songs, instant playback, no downloads, no waiting. The only catch was, to do this legally, they needed the labels. And the labels, burned by a decade of digital disasters, were not feeling generous. They wanted equity. They wanted guaranteed payments. They wanted a pound of flesh before they handed over a single track. Ek and Lorentzen agreed. They signed deals that gave the major labels ownership stakes in Spotify, massive advance payments, and royalty rates so high that for every dollar of revenue, most of it was already spoken for before Spotify even turned on the servers. They did not buy a library. They rented it on terrible terms and built a business on top. Here's the part that breaks most people's brains the first time they see it. When you pay Spotify $10 or $11 a month, Spotify does not keep that money, not most of it, not even close to half of it. Roughly 70 cents of every dollar in revenue flows out the door to rights holders. Some goes to record labels, some goes to publishers, some trickles down eventually to the actual humans who wrote and performed the songs. What is left, that remaining 30 cents or so, has to pay for everything else. Servers running in dozens of countries, bandwidth for billions of hours of audio, engineers building recommendation algorithms, marketing campaigns, customer support, salaries, offices, taxes, and somewhere, somehow, profit. For most of Spotify's life, that math did not work. The 30 cents was not enough. The company posted loss after loss, year after year. Investors watched it burn cash like a furnace. Critics called it a bad business dressed up as a good one. And every time Spotify tried to raise prices, the labels whispered, "Louder royalties, please." Every time Spotify tried to cut costs, a new competitor appeared, armed with deeper pockets and the same catalog. It was the definition of a trap. Too big to fail. Too expensive to win. And yet, Ek kept saying the same thing in every interview. Scale. Scale is the answer. And in a strange way, he was right, just not in the way most people expected. The secret to understanding why Spotify survived is understanding the difference between a fixed cost and a variable cost. When you build a factory that makes cars, every new car costs you steel, rubber, glass, and labor. Every unit has a real stubborn cost baked into it. That is variable. You cannot escape it by getting bigger. But when you build a streaming platform, the story is different. The songs themselves are, in a sense, a fixed library. Once a track is licensed and sitting on Spotify's servers, it costs almost nothing to stream it one more time. A fraction of a penny in bandwidth. Some electricity, some cooling. The royalty payment is technically a variable cost, tied to each stream, but even that behaves strangely at scale, because the deals are renegotiated as Spotify grows. Meanwhile, the truly huge costs, the engineers, the data centers, the global marketing, the licensing negotiations themselves, are fixed. They do not grow in a straight line with users. If you have 10 million users, your engineering team is maybe 500 people. If you have 600 million users, your engineering team is not 30,000 people. It might be 8,000. So every additional subscriber that signs up adds almost full margin contribution on top of a cost base that barely moves. This is the lever Eck was betting on. Lose money at 10 million users, break even at 200 million, make real money at 500 million, stretch the fixed costs over a bigger and bigger crowd until the per-user math finally tips into profit. It is a race. And Spotify spent a decade running it in the dark. But there is a second trick, one that is even more important than scale, and it is hidden in plain sight inside the business model. Spotify does not just sell subscriptions, it runs a free tier. For years, the free tier was considered by many analysts to be a liability, a loss leader. Free users pay nothing directly, yet Spotify still has to pay royalties on the songs they stream, funded only by ads. The gross margin on a free user was historically terrible, sometimes negative once you factored in ad sales costs. So why keep them? Why pour money into a segment that bleeds? Because the free tier is the world's largest, most targeted, most efficient funnel into paid subscriptions that the music industry has ever seen. A free user streams for a week, then a month, then a year. They build playlists. They save albums. They let the algorithm learn their taste. They come to rely on Spotify the way people rely on their morning coffee. And then at the exact right moment, when they are tired of ads, or they get a car with Bluetooth, or a partner who hates ads in the kitchen, they convert. They pay. That free tier is not a charity. It is a machine for manufacturing paying customers at almost zero acquisition cost, which were while competitors like Apple Music and Amazon Music have to spend heavily on advertising to find new subscribers. Spotify lets users sign up for free, enjoy the product, and walk themselves willingly to the checkout. And because the competitors refuse to run a real free tier at the same scale, Spotify has a funnel they literally cannot copy. Now layer on another quiet weapon: data. Every time you stream a song, skip a track, add an album to your library, or listen to a sleep playlist at 2 a.m., Spotify is watching. Not in a creepy sense exactly, in a commercial sense. The company has built one of the most detailed maps of human listening behavior ever assembled. What songs you love. What songs you skip after 9 seconds. What mood you gravitate to on Sunday mornings. What artists you put on repeat when you are working. That data fuels the recommendation engine, which is genuinely one of the best in the world. Discover Weekly, Release Radar, Daily Mixes. Those features are not magic. They are statistics, dressed up in a very friendly interface. And the better those recommendations get, the more users listen. The more they listen, the better the data. The better the data, the harder it is to switch to a competitor. Because moving to a new service means rebuilding your entire taste profile from zero. Your friend's playlist, your careful library, your algorithmic fingerprint, all gone. That friction is not technical, it is emotional. And Spotify has spent 15 years making it as heavy as possible. without ever asking you to notice. The data also quietly feeds a different business. Advertisers pay for access to listeners who have been sliced by age, region, taste, and mood. Brands pay to get their songs on high-traffic playlists. Labels pay, through various mechanisms, for visibility. The streams may lose money in isolation, but the data the streams produce is slowly building a second revenue engine on top. Still, by the mid-2010 ES, even with scale and free-to-paid funnels and world-class recommendations, the fundamental problem had not gone away. The labels held the catalog, and whoever holds the catalog holds the leverage. Spotify was growing, but its costs were growing almost as fast because every new stream meant more royalties paid out. If the company wanted to ever break free, it needed content that it either owned or controlled on much cheaper terms, something where the variable cost was dramatically lower than music royalties. And this is where the strategy gets really interesting. Eck made a decision that looked insane at the time. He announced that Spotify would spend billions of dollars pivoting into podcasts, not just hosting them, which it already did for free, but exclusively producing, buying, and licensing them. The Joe Rogan deal, reportedly worth over $200 million. Acquisitions of Gimlet Media, Parcast, Anchor, The Ringer. Huge, expensive bets on shows nobody was sure would move the needle. Why? Because podcasts have the opposite cost structure to music. A podcast episode is produced once. Spotify either owns it outright or licenses it for a flat fee, not a per-stream royalty. Every extra listen is almost pure margin. If you can shift even 10% of a user's listening time from music, where Spotify pays 70 cents on the dollar, to podcasts, where Spotify might pay 10, the entire economics of the platform start to bend. The unit that loses money on every stream becomes a unit that makes money on every stream, depending on what you are streaming. The podcast bet did not work overnight. Some of the acquisitions underperformed, some shows flopped. Joe Rogan drew controversy that distracted from the numbers. Internal reorgs were messy. Critics piled on and pointed to billions of dollars of content spend and called it a disaster. But quietly, the underlying math started working. By the time Spotify crossed into meaningful profitability in 2024, podcasts were a core reason. They had pushed up gross margin. They had extended user listening time. They had given Spotify leverage against music labels during the next round of royalty negotiations, because suddenly, a growing chunk of the company's value was no longer dependent on the major label's catalog. That is a structural shift. It does not show up as a single headline. It shows up slowly, over many quarters, as the cost of revenue as a percentage ticks down. A point here, a point there. On tens of billions of dollars of revenue, a point is a fortune. Meanwhile, Spotify started aggressively cutting costs elsewhere. Layoffs, trimmed perks, more automation. A much sharper discipline on what content was worth paying for and what was not. The company stopped trying to win every audio category and started focusing on where margin actually came from. And suddenly, after 15 years of losses, the financial statements stopped looking like a cautionary tale and started looking like something rarer, a subscription platform with 600 million users, climbing margins, and real durable free cash flow. So Spotify has scale. It has the free tier funnel. It has data. It has podcasts shifting the cost mix. But there is one more pillar, and it is the one that changes how you see the entire industry once you understand it. The pillar is power. Quiet, structural power. When Spotify launched, it was the beggar at the door, pleading with labels to license their catalogs. Today, the relationship has inverted more than most people realize. The three major labels, Universal, Sony, and Warner, still control the majority of the world's commercially important music, but a staggering share of their own revenue now flows through Spotify. Depending on the year and the label, streaming makes up well over half, sometimes closer to 3/4, of a major label's recorded music income. And inside of that streaming slice, Spotify alone is often the single largest contributor. If Spotify pulled a label's catalog tomorrow, that label would not die, but its stock price would flinch hard, and every executive in the room would feel it. That is not the relationship of a vendor and a customer. That is the relationship of codependence. Spotify needs the music, but the labels now equally need Spotify to keep streaming the music. And the moment that dependency crossed a certain threshold, the negotiating dynamic quietly changed. Spotify could push harder on things that used to be non-negotiable. Discovery mode, where artists agree to accept lower royalties in exchange for algorithmic promotion. Two-sided marketplace tools, where labels and artists pay for additional visibility. Bundle pricing, where music is blended with audiobooks and podcasts, reducing the effective royalty per music stream. Each of these is a small shift. Together, they represent a slow reshaping of who has leverage. Audiobooks are a perfect example of this quiet shift. A few years ago, Spotify bundled audiobooks into premium subscriptions. On the surface, this looked like a generous gift to users. 15 hours of audiobook listening, included in the monthly fee, at no extra charge. But under the hood, bundling has a very specific accounting effect. When a subscription includes music, audiobooks, and podcasts, Spotify can allocate a portion of the monthly revenue to each category. Royalties are paid based on how much of the price is attributed to music. If Spotify says this bundle is worth $10, but the audiobook portion is worth $3 of those dollars, then only $7 is the base for music royalty calculations. Labels fought this. Publishers fought this. Songwriters went public with complaints. But the legal and contractual structure held, at least for now. And the result was a subtle but meaningful reduction in the effective royalty rate Spotify pays per music stream, without ever formally renegotiating a music deal. That is the move of a company that has grown up. It no longer begs, it restructures. And when you zoom out, you can see similar tactics appearing in other places. Podcast ad revenue that does not share with the music rights holders. Direct marketing tools sold to artists. Ad-supported tiers with tighter ad load rules that squeeze more revenue out of every free listener. Each one pushes the unit economics a little further in Spotify's favor, while the headline price of a subscription barely moves. Let us talk about the users, because in some ways they are the forgotten protagonists of this story. Spotify has trained an entire global generation to think of music as something that flows, like water. You do not buy it. You do not even really choose most of it. You drift through it. Algorithms shape the morning. Playlists shape the workout. Radio features shape the drive home. The act of active discovery, going to a store, reading a review, making a purchase, is almost gone for most people born after the year 2000. That shift is worth more to Spotify than any single feature. Because when people stop thinking of music as a collection of discrete products and start thinking of it as an ambient utility, the identity of the provider becomes incredibly sticky. You do not think about where your water comes from until someone tries to change the tap. Spotify is the tap. Apple Music, Amazon Music, YouTube Music, Tidal, Deezer. All of them have technically comparable catalogs. Many have deeper pockets. Some are bundled with hardware or ecosystems that should, in theory, give them a massive advantage. And yet, Spotify remains the default for hundreds of millions of listeners. That is brand. That is habit. That is a decade of being the product everyone just had. And every year that passes, that default becomes harder to uproot, not easier. A new competitor would need not just to match the catalog, not just to match the recommendations, but to convince a user to re-import their entire listening life onto a new platform. The switching cost is low in money and high in identity, which in a subscription business is exactly the kind of moat you want. Now, it is worth being honest about the cracks in the story because this is not a clean fairy tale. Artists, especially independent and mid-tier artists, have very real grievances with how streaming pays them. The per-stream rate, often quoted at fractions of a cent, means that even a song with 1 million streams may generate only a few $1,000s for the artist after everyone else has taken their cut. Spotify did not invent this, The royalty flow is shaped by label contracts and industry conventions, but the company has become the most visible face of a model. This is an office one that many musicians feel is broken. There is also regulatory risk. In Europe, in the United States, in India, in several other markets, regulators have started asking pointed questions about streaming economics, app store fees, bundling, and platform power. Apple and Google still control the mobile rails Spotify rides on and have their own music services, which creates constant friction over in-app payments and preferential treatment. Competition from Chinese streaming giants in Asia, from regional players in Latin America, and from newer AI-driven music generation tools all sit on the horizon. And the biggest wild card of all is AI-generated music itself. If a model can produce unlimited, cheap, royalty-free tracks that are good enough for background playlists, the cost structure of streaming could shift even more dramatically in favor of platforms like Spotify and away from traditional rights holders. Which sounds great for margin until you realize it could also gut the creative economy Spotify depends on for the content people actually seek out by name. These tensions are not theoretical. They are baked into the next 10 years of the business. Even with all that, step back and look at what Spotify has actually built. A single app on almost every phone on Earth that has become the default way over 600 million people listen to audio. A global negotiation position that forces some of the oldest and most powerful companies in media to reshape their contracts. A data engine so precise it can predict with uncanny accuracy what you might want to hear next. A business model that took 15 years to make sense, that required patience most public companies are not allowed to have, and that finally, in the last couple of years, has started generating the kind of cash that silences even its loudest critics. The core insight Eck bet the company on was simple. If you lose money on every stream but capture the entire habit, eventually the habit becomes worth more than the losses. You are not in the music business. You are in the attention business. And attention, once captured at scale, becomes its own economy. Advertisers pay for it. Artists compete for it. Brands try to borrow it. Investors price it. And the operator at the center, the one routing billions of hours of listening per month, becomes very hard to dislodge. Spotify's losses on each stream were never the disease. They were the price of admission to a bigger game. A game where the prize was not being the most profitable music company. It was being the most necessary one. There is a lesson tucked inside this story that goes far beyond music. Many of the most important technology businesses of the last 2 decades followed a version of this same pattern. Amazon lost money on retail for years while building logistics. Netflix burned cash on content while building a subscription habit. Uber subsidized rides while building network density. In each case, the short-term unit economics looked irrational. In each case, the long-term position became almost uncontestable. Spotify is the audio version of that trade. What looks like a bleeding business model on a quarterly report is, zoomed out, a strategic investment in lock-in, pay the labels, feed the free tier, tune the algorithms, buy the podcasts, bundle the audiobooks. Repeat until the thing you built is not just a service, but a default behavior. Defaults are priceless. They do not show up on a balance sheet until one day they show up on every balance sheet as the quiet foundation of a very large and very durable cash flow. That is what Spotify is becoming. Not a cool app, not a music startup. An audio infrastructure company whose entire architecture was designed to absorb losses early, stretch fixed costs across a massive user base, and gradually bend the cost curve of content into its own favor? And the funniest part is, the thing most critics used to mock, the fact that Spotify loses money on every stream, was actually the feature, not the bug. It was the barrier to entry because the only way to outcompete Spotify was to be willing to lose exactly as much money for exactly as long, on exactly as many streams. And very few companies on Earth have that kind of patience. So the next time you tap a song, and it appears instantly from a library of 100 million tracks, Understand what is really happening under the hood. A company is taking a small loss on that stream. A record label is taking a royalty. A publisher is taking a share. A server farm is burning a tiny amount of electricity. An algorithm is noting what you played and what you skipped and updating a model that will try to keep you listening for another hour. And somewhere in Stockholm, a set of strategists are calculating how to turn that single tap into a slightly better margin next quarter, and the quarter after that, and the one after that. Spotify is not magic. It is the most patient long-term bet in the history of the music industry, built on the strange insight that losing money correctly for long enough can be worth more than winning early. And if that kind of quiet structural thinking is what you come here for, you will probably enjoy our full breakdown of how Netflix almost destroyed itself learning the same lesson, because the parallels between those two companies are deeper than most people notice. And that video lives right over here on the channel when you are ready for the next chapter.